Welcome to Corporate Finance Explained, where we break down the essential topics every corporate finance professional needs to know. This series is narrated by AI, created using CFI's expert training materials, and designed to help you stay ahead in the world of finance. Enjoy this week's deep dive.
Welcome back to the deep dive. Today, let's just start with a massive reality check.
Okay, I'm ready.
If you look back at the last few years, honestly, just pick any year since 2020 at random. It kind of puts a big dent in the idea that we can predict the future with a spreadsheet, doesn't it?
It certainly does. The spreadsheet usually loses that fight.
Think about it. We've seen supply chains just snap overnight.
Yeah.
We've seen interest rates shift faster than most companies can even update their forecast cycles.
And consumer demand just spikes up to the moon and then, boom, plummets back to Earth.
Exactly.
Yeah.
It feels like the only constant is that Plan A, that beautiful laminated document everyone signs in December, is usually out the window by, February?
If you're lucky. And that volatility has forced a really profound shift in how the best finance teams operate. For a long time, the main question in a boardroom was simply, what is our plan?
Right. It was all about precision.
All about precision. But in this environment, precision is actually a trap. You have to ask a much scarier, but way more necessary question, which is, what happens if we're wrong?
And that is exactly what we are unpacking today. We're doing a deep dive into corporate scenario planning. And before you roll your eyes and think this is just some, academic theory or crystal ball gazing, stick with us. Because the sources we're looking at show this is a massive competitive advantage.
It is. We aren't talking about guessing. We're talking about a specific methodology used by giants like Microsoft, Amazon, Delta to navigate chaos. It's about how companies move from reactive panic,
which is where most of us live.
It's where most organizations live, yes. And they move to something the research calls dynamic reallocation.
Dynamic reallocation. I like the sound of that. It sounds much better than running around with your hair on fire, which is my usual strategy.
It's a little more structured.
So let's start at the beginning. What exactly is scenario planning? Beyond just a buzzword, because I think a lot of people confuse planning with just, forecasting.
That's a crucial distinction. Forecasting is usually an attempt to predict the future. You pick a single number. Say revenue will be 100 million next year. It's singular.
Right.
Scenario planning is admitting you don't know the number. It's the practice of modeling multiple plausible futures to understand their impact on your finances.
And I think that word plausible is key, right? This isn't science fiction.
Not at all. It's not asking what if aliens land. It's asking what if inflation hits 8% and, stays there.
Got it.
Exactly. And the most effective teams usually break this down into three core scenarios. First, you've got your base case. This is what you expect to happen. It's your standard forecast.
The one that gets presented to the board. The political number, if we're being honest.
Often, yes. The number everyone agrees to aim for to get their bonuses. But then you have the upside case, a world where conditions are more favorable than you expect.
Okay, so more demand, lower costs, that kind of thing.
Exactly. And then, crucially, you have the downside case. This is the critical one where your key assumptions just break.
And here is where it gets really interesting, according to the research we've got. The common mistake isn't that companies don't have a downside case, it's how they treat it.
That's the key insight. Most teams treat the base case as the plan. They pour all their energy into that one number. The upside and downside cases are treated as mere theoretical exercises.
Right, they're just appendices in the slide deck that nobody really looks at unless things go wrong.
Exactly. Here's what we're doing, and here's a scary graph we made just to show we did our homework. But the correct approach is completely different.
So what do the smart teams do?
They treat all three scenarios as active decision-making tools. Each scenario, even the downside one, has to force trade-offs. You look at that downside case and ask, okay, if this happens, what do we actually do about pricing? What about hiring? How does this change our inventory strategy?
It's like rehearsing the decision before you have to make it under pressure.
That's a perfect way to put it. It's the difference between having a fire extinguisher in the closet and actually knowing how to pull the pin.
Okay, that makes sense. But let's get into the weeds a bit. How do we actually build these? I imagine it's more complex than just opening Excel and typing revenue goes down 10%.
It is, yeah. This brings us to the mechanics of it, specifically something called sensitivity analysis.
Okay, let's unpack that. How do teams figure out what variables to even put in these models?
You start by identifying the drivers. These are the variables that actually, move the needle for your specific business. For some, it might be revenue growth or pricing. For others, it's input costs or foreign exchange rates, FX, or interest rates.
So you don't worry about every single line item on the P&L. You focus on the big levers.
Precisely. You have to separate the noise from the actual risk. Once you have those drivers, you perform the analysis. This involves testing one variable at a time to see how the changes flow through to the bottom line.
To things like revenue, EBITDA, cash flow.
Right. And liquidity.
Let's pause on a couple of those just to be sure. EBITDA is basically your operational profitability before all the accounting and tax stuff, right?
Correct. Earnings before interest, taxes, depreciation, and amortization. It's a clean measure of cash generation from operations.
But you also mentioned liquidity. That can be the real killer.
It's often the immediate killer. Liquidity is just, do you have enough cash in the bank to pay the bills today?
So the analysis asks, okay, what happens to our cash if the price of oil goes up 5%? What about 10%?
Exactly that. And you do it for each key driver. This process highlights which of your assumptions actually matter and which ones, don't. You might find a huge swing in marketing spend barely touches your liquidity, but a tiny shift in the dollar-euro exchange rate puts you in the red.
That's fascinating. It tells you what you actually need to worry about. But surely variables don't move one at a time in the real world. When it rains, it pours.
You're absolutely right. The real world is messy. That single variable test is just the diagnostic. Once you understand the individual sensitivities, you build the narrative. You combine them into coherent scenarios.
So it's not random stress tests. It's a realistic story.
A realistic story. So instead of just variables changing, it's what does the world look like if a recession hits and the supply chains tighten at the same time?
And that kind of narrative thinking helps you spot hidden dangers, like, what were they called? Covenant breaches.
Covenant breaches, yes. That sounds ominous because it is.
What is that exactly?
Most corporate debt comes with rules covenants. For example, a rule might say, your debt cannot be more than 4 times your EBITDA. If your scenario shows EBITDA dropping, you might accidentally break that rule.
And if you break the rule,
the bank can call in your loan, demand immediate repayment.
Wow.
And that is often how bankruptcy happens. It's not running out of money slowly. It's breaking a rule and having all your debt called in instantly. Good scenario planning spots those danger zones months in advance.
Okay, that definitely puts the stakes in perspective. This isn't just about missing a bonus. It's about keeping the lights on. I want to see this in action. The sources had some great examples. Let's start with Microsoft.
Great example.
When I think of Microsoft, I just think of a company that prints money. Why do they even need this?
Well, even money printing machines have to deal with uncertainty. Microsoft has this massive portfolio cloud, enterprise software, hardware. Those sectors don't always move in sync.
Right. Buying a Surface laptop is a very different decision than signing a 5-year Azure cloud contract.
Totally different. So their finance teams model scenarios around things like, say, an enterprise IT spending slowdown versus continued cloud growth. They're asking, what if companies stop buying new laptops but keep moving data to the cloud?
And how does that change what they actually do?
This is that dynamic reallocation we talked about. During periods of macro uncertainty, they use these downside scenarios to make a really tough call. They decided to slow hiring and discretionary spending in vulnerable segments, like Windows OEM sale.
Okay, so pulling back on the reins in some places?
But, and this is the whole key, at the exact same time, they accelerated capital investment in Azure data centers, where the model showed demand was still incredibly resilient.
Oh, that is cool. So it's not a blanket freeze everything. It's slow down here so we can speed up there.
That's it. That is the definition of capital reallocation. It's not a static forecast where you set a budget in January and stick to it no matter what.
Yeah.
They fund the growth engine even when the rest of the economy looks worrying.
That's a really powerful distinction. Active management versus just passive budgeting. Now let's look at a different beast. Proctor Gamble, P&G.
Mm-hmm.
They sell soap and diapers. Demand for that is usually pretty stable, right? People always need toothpaste.
True. Demand is stable, but their costs are highly volatile. P&G is a massive buyer of commodities.
What kind of things are we talking about?
We're talking pulp for paper products, resin for all their plastic packaging, and of course energy to run the factories. Plus, they operate globally, so currency volatility is a huge factor for them.
Ah, I see. So for them, the scary scenario isn't nobody buys Tide. It's It costs twice as much to make the bottle.
Precisely. So they build scenarios tied specifically to those input costs. They model exactly how their margins respond to inflation in pulp or resin.
And what does that let them do? Why not just raise prices when costs go up?
Because of elasticity. It's a key economic concept. If you raise prices too fast or you pass on 100% of the cost increase, consumers might just switch to cheaper generic brands.
It's a private label threat.
Ugh.
The store brand starts to look a lot better when the name brand jumps 20%.
Exactly. So scenario planning helps prevent overcorrecting. Without a model, the knee-jerk reaction to a cost spike is often to slash other costs aggressively or just jack up prices overnight.
Which can kill demand.
It can kill demand. But because P&G has modeled this, they can implement gradual price increases, they can adjust their promotional spending surgically. It gives them a steady hand on the tiller so they don't panic.
Now, those are examples of managing through, let's call it normal volatility. But what about when things really hit the fan? The sources talked about Delta Airlines.
Delta is a great example of crisis management. Airlines are exposed to two of the most volatile things on Earth: fuel prices and macroeconomic shocks.
And sometimes both at once.
Sometimes both at once. So Delta is always modeling severe downside cases, demand collapses, fuel spikes. But the most valuable application of this came during COVID.
I can't imagine a worse scenario for an airline than 2020. Revenue went to zero overnight.
It was the ultimate downside case. But because they had that muscle memory of scenario planning, they didn't just freeze. The models helped them determine specifically how much liquidity, how much cash they needed to raise.
So they weren't just guessing we need money. They knew how much.
They knew how much, and they knew how long that cash would last under different recovery timelines. A slow recovery, a fast one, a false start.
Which let them plan things like deferring capital expenditures.
Exactly when to stop buying new planes or upgrading terminals. And that allowed them to act decisively. They went out and raised cash early when the markets were still somewhat functioning, rather than waiting until they were desperate. They survived because they had mapped out the terrain of the crisis before they were in the middle of it.
Then there's Amazon. They had the opposite problem during the pandemic, right? Too much demand.
A fascinating case. The post-pandemic pivot. Remember, AWS and their fulfillment network require massive capital investment. You have to build the warehouse before you can ship the package.
And in 2020, everyone was buying everything online.
So the base case looked incredible. But Amazon's finance teams were modeling the downside, specifically the risk of demand normalization.
Meaning, what happens when people feel safe enough to go back to the mall?
Exactly. They modeled a world where the e-commerce surge didn't last forever. And when the data started to turn, those models supported some very difficult decisions.
Like what?
Slowing down warehouse expansion, renegotiating leases, rebalancing their capital expenditures to preserve free cash flow.
That must have been a hard sell internally. Hey, sales are through the roof. Let's stop building warehouses.
Incredibly hard. But because they had the scenario analysis, they could show why it was necessary to protect the long-term health of the company. They avoided getting stuck with massive overcapacity.
Which brings us perfectly to the cautionary tale. Peloton.
Ah, yes. Peloton.
Now, looking back, it's easy to judge. But at the time, they were on top of the world. What went wrong?
The setup was just so seductive, explosive growth, but the trap was linear projection. Their financial plans essentially assumed that those crazy high demand levels would just persist indefinitely.
They thought the pandemic behavior was the new permanent normal.
They did. And look, it's human nature to extrapolate the good times, but the failure wasn't just optimism, it was a failure of scenario planning. They didn't really integrate a downside scenario one where gyms reopened into their actual decision making.
But they might have had a slide that said, what if demand drops? But they didn't act on it.
Exactly. This is about operating leverage. Peloton has high fixed costs, factories, instructors, music rights. When revenue drops, those costs stay the same, and profits just evaporate. They didn't let that downside case influence their inventory planning. They kept building bikes as if the music would never stop.
So when the music stopped,
They faced a mountain of excess inventory, severe margin pressure, and a massive cash flow strain. The lesson here isn't that they failed to predict the future perfectly. The failure was not letting the downside case influence their investment decisions during the good times.
that's a huge takeaway. It's really hard to look at the downside when you're popping champagne.
That is the discipline. It takes real guts to say, let's be careful when everyone else is celebrating.
So, bring this back to our listener. Maybe they don't run Microsoft. Maybe they run a small business, or they're just trying to understand their own company. What's the so what here?
It matters because resilience isn't just a buzzword. It's built on 3 tangible things that scenario planning gives you.
Okay, break them down for us.
First is pricing. You need to know how much pricing power you actually have before demand softens. If you wait until you're in a crisis to test your prices, it's too late.
Okay, number 2.
Supply chain. You need to understand what happens to your working capital if there are delays. If your inventory gets stuck on a boat, do you have enough cash to pay your suppliers? Scenario planning answers that.
That feels very relevant right now. And the third?
Investments. It just forces discipline. It compels you to ask, does this project still make sense if the world gets 10% worse? If the answer is no, maybe you shouldn't do it.
It sounds like it changes the conversation completely, at every level.
It changes the conversation in treasury, in corporate development, and most importantly, in the boardroom.
How so?
It moves the discussion from, here is the forecast, trust us, to here is where we win, and here is exactly what breaks if costs spike. It turns the finance team from scorekeepers into strategic navigators.
I love that. Here is what breaks. It's such an honest way to look at a business.
It's the only honest way. And frankly, it builds more trust. Admitting risk shows competence, not weakness.
So as we wrap this up, what is the one big takeaway? If I'm listening and I want to start thinking this way, what's my mindset?
I think the summary is this. Strong finance teams don't wait for volatility to start planning. They build the muscle before it's needed.
It's training for the fight before you even step in the ring.
Right. And remember, the goal isn't perfection. It's preparedness. It is so much better to be roughly right and prepared to pivot than to be precisely wrong and stuck.
Precisely wrong. I think we've all seen a few spreadsheets that were precisely wrong to the second decimal point.
We certainly have.
It does raise a really provocative thought to end on, though. If the biggest, most data-rich companies in the world, Microsoft, Amazon, I bet they can't predict the future, why are the rest of us so obsessed with trying to guess perfectly?
It's a great question. Perhaps the ultimate competitive advantage isn't better forecasting at all. It's better adapting. The winner isn't the one with the clearest crystal ball. It's the one with the fastest reflexes.
I love that.
Yeah.
So to everyone listening, take a look at your plans for your company, your department, your own finances, and ask yourself that one simple question. What happens if I'm wrong? It might just save you.
It's the most important question you can ask.
Thanks for diving deep with us today. We'll catch you on the next one.
See you then.
Thanks for listening to Corporate Finance Explained. If you found this episode valuable, be sure to check out more episodes and explore CFI's highly rated courses at corporatefinanceinstitute.com. Don't forget to subscribe for more deep dives into essential finance topics. See you next time.